Guys, busy week this week. Two reports have already came out this morning that I'm going to get into in 2 seconds. But here is the earnings calendar for this week. A couple of the ones that I'm personally interested in. Nothing from today, but here, Dick's Sporting Goods, Abercrombie to see how retail's going, Salesforce. That's a big driver because they handle a lot of employees, a lot of sales, etc. I want to see how they're reporting. HPQ, only because I own their stock. Remember, I don't care how they report. I just want to see if there's anything that's materially changed my thesis that's announced. In terms of Thursday, Costco, Dell, Ulta. I just started a position in Ulta, so that's pretty awesome to me. Best Buy to see how they're talking about with retail, etc. So guys, that's the big earnings calendar for this week. But today, the Case-Shiller Index came out again. They were expected to have 0.3% month-over-month growth on home sales. They came in at 0.3%. Guys, even with interest rates so high, supply and demand worked its ugly head. Supply was insanely low. You've got to remember supply is what's driving these prices. Now, for those of you who think interest rates are insanely high, they're not. They're about where they have been or should be based on history. We've just been spoiled as of late with all these low interest rates of 3%, 3.5%, etc. Normal times are probably here. I don't know where rates are going to go, but remember, for rates to go lower, what would have to happen in the economy? I think you have to see a shift from a very positive economic outlook to a negative one and possibly a recession. They don't just cut rates to cut rates. This is what I want everybody to understand, that cutting of rates would have to be coupled with some slowdown in the economy. So you have to ask yourself, which one do you want more? Home prices being up. If you own a home, if you've been there for a while, awesome, nice work, great job. A friend of mine reached out to me last week and said, Paul, I want to move. Houses are expensive. My current home is worth double what I paid, and I owe about 1/4 of what it's worth. What would you do? Would you rent it out or would you sell it? I go, I'd rent it out all day. You have a 3% mortgage. Don't touch that thing. And like I expected, he sold. Why? Because it's nice to have that feel good inside. Like, oh, I sold. I got this gain. I can go put it as down payment. He will never find a better investment with better cash flow in his entire life. So before you go sell, not telling you not to sell your home, but before you sell, think about it if it's possible for you to rent out your home if you have a low interest rate. I really do recommend that you look into it. I don't know your situation. You might need the money for something else, for a down payment, etc. But if you can afford to keep that home, it's going to be hard to replace that kind of income. It's going to be hard to replace that kind of asset. I would recommend thinking it through. I'm not saying to do it. Second, consumer confidence. Now, consumer confidence and consumer sentiment are essentially the same thing, but two different sources. They were expecting the 4th month of decline. There were 3 months of declines in consumer confidence. They were expecting a 4th month at 96%. Guess what? We came in at 102. Absolutely crushed. Last month was 97.5. They came in at 102. So they crushed on that one. Why? Good question. These things are very fickle. Now, I do want everybody to see this. This is consumer sentiment from the University of Michigan, not the consumer confidence, but it's essentially the same thing. Look at the areas in gray, areas in gray, areas in gray, areas in gray. Apart from right here, before the areas of gray, they're always higher before the recession. Why? Because it's asking people, how do you feel about the future? And when things are not in a recession, you feel great. When things are in a recession, you feel crappy. It's not a leading indicator. It's a lagging indicator. It means people are responding to our recent history. When I hear people say like, well, the consumer is confident, like, well, yeah, the consumer was very confident right before the financial crisis. Look at this. We were actually more confident than today. Actually, based on the consumer sentiment index from the University of Michigan. This was it right before the downturn. Here we are right now. I don't want to hear it, guys. Don't look at the consumer confidence and think, oh, we're rosy, don't worry about it. Consumers react to what's going on in their life right now. Just like when things at the pits are terrible, in recessions, people are sitting here saying, interesting, maybe there was a recession back here in 2022 that we didn't announce. Remember, we had 2 quarters of negative growth back in 2022 that nobody wants to talk about. Nobody wants to acknowledge. They might look back and say, that was a recession back then. But right now, the consumer feels very confident. And I'm not trying to be a futster. What I'm trying to do is explain how the world works. And if you like the way I'm talking about it, and if you're new to the channel, do me a favor, subscribe. Do yourself a favor, subscribe. I have a different way of approaching the world. I'm actually a value investor, not in just words, but in action as well. And I encourage you to come listen, because with these reports that come out, we do 4 or 5 videos a week reacting to the economy, reacting to companies' earnings releases, and major news in the stock market and in the real estate world. So come join us, subscribe to the channel. I think you'll really appreciate that. Now, for those of you who have been watching the channel, you know better than anybody that I like looking at metrics to compare where we are today versus history. And the most reliable metric, according to Warren Buffett, on where we stand at any given time based on valuations is the stock market GDP ratio, which was basically unchanged over the last week. It is still at 100% overvalued, almost 102% overvalued. Now, there are arguments against that. Oh, it doesn't factor in income or blah, blah, blah. Fine. Let's take the entire earnings of the S&P 500 in the 10-year cyclically adjusted PE ratio. All that does is it takes the last 10 years of earnings, brings it to today using inflation in today's dollars, and divides it, and we're at 34.71, which is 103% overvalued. So slightly worse than the stock market to GDP ratio. Now, does that mean a crash is imminent? No. Does that mean that the future probably is not going to be as good as the past? Yeah, probably. This stock market GDP ratio has an extremely high correlation to future returns. Let me show you right now. Let's go back to 1982, which was the lowest low. And at that point, the stock market was undervalued by 65%. The following 10 years, not including dividends, returns were 14.3% a year. Not including dividends. And back then, dividend yield was 3 or 4%. Now, let's go to 2000. Considered the worst bull market, the most overvalued bull market of all time. Where was the ratio? Only 55% overvalued, 52% overvalued. The next 10 year returns, -3, -2%, not including dividends. Guys, we are double the overvaluation than this. Now, could it be a new shift? Sure, but what would that entail? That would entail that people don't care that every investment is the present value of all future cash flow. I can understand it if interest rates were still 0%. Okay, 0% interest, I'm okay making 5 or 6% return on my money. But now I can get 5.4% in 90-day treasuries. I can get 4.4% in 10-year treasuries. Why would I ever invest in the stock market to get bad returns then? That's what you have to ask yourself. Now, has it been going on for a long time? Guys, we've been overvalued for a very long time. In 2021, when the S&P was below today's levels, we were 100% overvalued. And we've been flat since then. That's 3 years of market going up about 20%. But you got to remember, guys, if you go back to the peak of early January 2022 to now, treasuries have outperformed the stock market. Even with this major uptick in the last year and a half, treasuries have overperformed the stock market. That's something to consider. Now, take what you want with that. I'm not telling you not to invest. I still believe that over time, stocks do this, and values do the straight line, but this is where prices go. And you should dollar cost average. That way you average this number. But if you're buying individual stocks, I think you need to be more cautious. Sit there and look at it and say, okay, is this a good value? Make sure you understand the company and make sure you're okay with the stock falling. Because I don't think the next 5 or 10 years are going to be nearly as good as the last 5 or 10 years. And there'll probably be a lot of volatility involved. Volatility is the friend of a true investor, a stock investor. They should want stocks to fall. You should get excited when stocks fall. Our community, our software, our insiders love it when stocks fall. So if that's appealing to you, click the link below. Join our community, get all the tools, etc. But guys, I'm hoping that this process helps you out in terms of making you a more emotionally stable investor, because that's how you're going to outperform. Everybody has the brain power to pick stocks. Not many people have the stomach to do it. I'm here to change that for the world. Thank you very much for your time.